The stock market can feel like a vast and confusing ocean. There are so many different types of companies and investments. It's overwhelming, but don't worry, we're here to break it down for you. One of the most important things to understand is the difference between cyclical and non-cyclical stocks. This distinction helps you make smarter investment decisions. It's all about aligning your investments with the ebb and flow of the economy. Investing in the stock market isn't about throwing darts at a board, it's about understanding the forces that drive company profits. Some companies are like ships riding high on a wave during economic booms. Others are like steady submarines, navigating the depths of recession without missing a beat. Knowing the difference is crucial. By understanding these two categories, you'll be well on your way to building a diversified portfolio. This will help you weather any economic storms. So, let's dive in. Cyclical stocks are like the thrill rides of the stock market. They're exciting when the economy is booming, but can take a nosedive during downturns. These companies sell goods and services that are in high demand during good times, but see a slump when belts tighten. Think about it this way. When the economy is strong, people have more disposable income. They're buying new cars, upgrading their homes, and indulging in luxury items. Companies in sectors like automotive, housing, and travel thrive during these periods. Their profits soar, and their stock prices follow suit. However, when the economy weakens and uncertainty sets in, consumers and businesses become more cautious. They cut back on discretionary spending, delaying big-ticket purchases. Suddenly, those once thriving cyclical companies see their sales plummet, their profits dwindle, and their stock prices tumble. Understanding the cyclical nature of these companies is crucial for investors. Timing the market becomes essential. Buying these stocks at the bottom of the cycle and selling at the peak can lead to significant returns, but mistiming the market can result in substantial losses. Therefore, carefully analyzing economic indicators and understanding industry trends are essential for navigating the world of cyclical stocks. Let's take a closer look at some sectors that exemplify cyclical stocks: shipping, materials, and fertilizers. These industries are heavily dependent on economic growth and industrial activity. When the economy is booming, demand for their products and services skyrockets. However, they experience significant slowdowns during economic contractions. Shipping companies, for example, transport goods across the globe. During periods of economic expansion, global trade flourishes. Businesses and consumers alike demand more goods, leading to a surge in shipping volumes. This increased demand translates into higher shipping rates and profits for shipping companies. Similarly, materials companies involved in producing raw materials like steel, aluminum, and copper benefit from increased construction, manufacturing, and infrastructure projects during economic upswings. As demand for their products rises, their profits grow. Fertilizer companies are another prime example of cyclical businesses. Fertilizers are essential for agricultural production. During economic booms, increased food demand and higher crop prices drive farmers to invest more in fertilizers to maximize their yields. This, in turn, boosts the profits of fertilizer manufacturers. However, when the economic tide turns, these sectors feel the pinch. Reduced consumer spending, decreased construction activity, and lower agricultural commodity prices all lead to a decline in demand for shipping, materials, and fertilizers. This decline results in lower profits and stock prices for companies operating in these sectors. Therefore, investors interested in cyclical stocks must carefully monitor economic indicators and industry trends to make informed investment decisions. Section 4. Weathering the storm, non-cyclical stocks. Now let's move on to the steadier side of the stock market, non-cyclical stocks. These are the companies that provide essential goods and services that people need regardless of the economic climate. Think of them as the steady utilities that keep the lights on even during a storm. These companies cater to our basic needs. They provide things like food, beverages, healthcare, and essential household products. People still need to eat, drink, and take care of their health even when times are tough. This consistent demand makes their earnings and stock prices less susceptible to economic fluctuations. While non-cyclical stocks may not experience the same dramatic growth as cyclical stocks during economic booms, they offer stability and resilience during downturns. This makes them attractive to investors seeking a safe haven for their money when the market becomes volatile. However, it's important to remember that not all non-cyclical stocks are created equal. Some companies within these sectors may be more innovative or better managed than others, leading to stronger growth prospects. Therefore, it's essential to conduct thorough research and due diligence before investing in any stock, even those considered non-cyclical. Section 5. Non-cyclical havens, consumer staples, utilities and healthcare. Let's delve into some specific sectors that exemplify non-cyclical stocks, consumer staples, utilities and healthcare. These industries provide essential goods and services that people rely on regardless of the economic climate, making them relatively stable investments. Consumer staples companies produce and distribute essential food, beverages, household products, and personal care items. Think of your local grocery store or pharmacy. These companies benefit from consistent demand as people need these products regardless of the economic situation. Utilities companies provide essential services like electricity, gas, and water. These are not luxuries, but necessities for homes and businesses. The demand for these services remains relatively stable regardless of economic conditions. People still need to heat their homes in the winter and cool them in the summer, regardless of the stock market's performance. Healthcare companies provide medical services, pharmaceuticals, and medical devices. The need for healthcare is constant as people require medical attention regardless of economic cycles. While economic downturns may lead to some elective procedures being postponed, the overall demand for healthcare remains relatively stable. Investing in these non-cyclical sectors can provide a sense of stability and security to your portfolio. However, it's crucial to remember that individual company performance within these sectors can vary. Always research and understand the specific companies you're considering investing in, even within these generally stable sectors. Section 6. Investment strategies, timing versus stability. Now that we understand the difference between cyclical and non-cyclical stocks, let's discuss how to incorporate them into your investment strategy. The key lies in understanding your investment goals, risk tolerance, and time horizon. For investors seeking growth and willing to take on more risk, cyclical stocks can offer significant upside potential, but timing is crucial. These investors need to carefully analyze economic indicators and industry trends to identify the bottom of the economic cycle, where cyclical stocks are often undervalued. Buying low and selling high as the economic cycle turns can yield substantial returns. However, timing the market is notoriously difficult, even for seasoned investors. Incorrectly predicting the economic cycle can lead to significant losses, especially for those with a shorter time horizon. Conversely, for investors seeking stability and capital preservation, non-cyclical stocks offer a more conservative approach. These stocks provide steady, though perhaps not spectacular, returns over time. They are less volatile than cyclical stocks and tend to hold their value better during market downturns. Non-cyclical stocks are particularly suitable for investors with a longer time horizon, such as those saving for retirement. Their consistent dividend payments and stable stock prices can provide a reliable stream of income and help weather market volatility. Section 7. Diversification, the key to a balanced portfolio. The key takeaway from all this is the importance of diversification. Don't put all your eggs in one basket, especially when it comes to the stock market. A well-diversified portfolio should include a mix of both cyclical and non-cyclical stocks. This balance helps mitigate risk and maximize returns over the long term. During economic booms, cyclical stocks will likely outperform, driving portfolio growth. Conversely, when the economy slows, non-cyclical stocks will provide stability and help preserve capital. Think of it like this. Cyclical stocks are your growth engine, providing the potential for significant returns, while non-cyclical stocks are your shock absorbers, cushioning your portfolio during turbulent times. The specific allocation between cyclical and non-cyclical stocks will depend on your individual investment goals, risk tolerance, and time horizon. A financial advisor can help you determine the optimal mix for your situation. By understanding the characteristics of both cyclical and non-cyclical stocks and incorporating them into a diversified portfolio, you can navigate the stock market with greater confidence and achieve your investment objectives over the long term. Remember, investing is a marathon, not a sprint, and a well-balanced approach is key to reaching the finish line.